Lodinda, can you hear me? One, two, three, test. All right, so Adinda, good morning, can you hear me? Good morning, Adinda, can you hear me? Okay. Okay, and you can see the slides as well, right? So whenever you want, we can start. Good morning, how are you? One, two, three, test. One, two, three, test. Should be able to hear me. Give me a yes if you can hear me. Is the volume okay? The volume should be okay. You should be able to see the screen now. Can you see the screen now? Should be able to see the screen. So you'll tell me when you want to start, okay? One, two, three, test. We are waiting to start. Okay. All right. They're waiting for a few people here. Thanks for joining. Good morning. This webinar today will be key. I'm going to talk about the industry as well, what's going on, how it works, and I'm sure I'm going to say things that nobody else tells you the truth. So stay and enjoy the content here. Welcome, good morning, Adam, Thomas, Adinda. Adinda, let me know when you want to start and we will go. Thanks for joining. Good morning, everyone. Good afternoon and good evening as well. For those of you from Europe and Australasia, thanks for joining. We'll start in a minute here and we'll talk about the changes in foreign regulations and what they mean for us retail traders. Welcome, Tatsuya. I'm going to talk about also how the industry works and give you information that very few people talk about. So stay today, and if we'll have time, we're also going to look at the dollar index and the euro to see what's going on there. Okay, so stay today. Very important webinar. Welcome, Tatsuya, Adam, Thomas. We'll be waiting a couple of minutes here and then start. This webinar is very important today. I'm going to talk about the industry, what's going on. If you're serious about trading, you have to know these things, or if you're starting or you want to get involved not only in the Forex market but also stocks, futures, this webinar is very, very important for you. Okay, so make sure you you stop whatever you're doing at the moment and listen to what I have to say here. This is very important. Gonna wait a couple of other minutes here, and then when we are ready, we're gonna start. Welcome everybody. Couple of minutes and we're gonna start. So welcome everybody. We are waiting here just another minute or so. All right, so we can start. So welcome, good afternoon, good morning, and good evening to all of you. Welcome to this webinar, Changes in Forex Regulations and What They Mean for Us Retail Traders. Today is May the 14th, 2018, and I am Giuseppe Basile, also known as the Fib Stalker. As you can see here, I'm also involved with the Canadian Society of Techie Analysts, which is the Canadian chapter of the International Federation of Techie Analysts. As usual, I want you to, if you are watching the recording here, to read and accept the usual disclaimer here. All the information I'm giving here is for your general information, and I do not endorse or support any of the brokers that are mentioned in this webinar. I will be about myself. The national director of the CSTA, the Canadian Society of Techie Analysts, and I'm a professional member as well. I published many papers, actually not 3, but now there are 6 papers for both the Italian and Canadian chapters of the IFTA. I have a computer science engineer background and also hold a master's in finance, and I'm a certified market technician. That happened in 2012. I started with my interest in the market in 2000s and committed to research in 2003, but I only understood the importance of mentoring in 2006. I have over 21,000 hours of exposures to the markets. I had mentors. I also recommend you get a mentor as well. Vantar, Pivica Jurasic, David Hasler are some of the names, and it's very, very important that you get to work with someone who has experience in the market. To me, it helped greatly. In fact, it made a big difference, all the difference in the world. I launched FibStalkerTraining.com in 2012, and I have now seven sessions of the FibStalker Master Coaching Program, and also a new coaching that is called the Fearless Trader Workshop. I'm going to talk about that later on. And I have also a community. If you want to get a free course and get all my free material, go to FibStalkerTraining.com free, and you can get it there. I also have a masterminds on Facebook. You can go to flipstokertrading.com/Facebook and friend me, and I'll introduce you to the group. All right. This is me, some of the names and researches I have completed in the years. So this is my contact information if you want to get in contact with me. flipstoker@gmail.com. I'm on Twitter, and again, have a look at the website, and if you want to get your free course, free ebook, and also 1 month in the analysis and trading room, just go to flipstokertrading.com/free. So let's get into the content here. Very, very important. What has changed? But I'm gonna take this opportunity also to talk about the industry and tell you how it works. Someone that nobody tells you. Okay, so is our agenda. We're going to look at the difference between professional trading versus retail trading, the statistics on average losses that retail traders starting traders, but also traders with experience who fund again their accounts, what happens to them. Then how the financial industry and the brokerage business works, and I'm sure that nobody tells you this information. And then we're going to look at the changes in regulations and trends and what it all means for us retail traders. And if we have time, we're also going to look at the dollar index and euro dollar, what's going on, but only if we have time. Okay, so we have a lot to cover. So let's start and look at the difference between professional and retail traders. Professionals and retail traders do trade in a totally different ways. Okay, and the first group makes money, the second group in average loses money. So these are the professionals. They use a systematic approach with 80% fundamentals and 20% technical. They have many positions open at one time, 10 to 20. They are hedged, and the overall portfolio has a low volatility. No one single position can destroy their account, what's going on in their account. They manage risk professionally. In fact, most companies and investment bank and trading boutiques, they have risk management systems that make sure that the risk is always under control, both the risk of the position as well as the risk of the overall account. Trading is their job. They want to do that until they retire. Okay, it's not a passion, it's not a hobby, it's not a way to make money, so they must be consistent. In fact, 90 to 95% of professionals traders win consistently, and they have an overall support system in their company that helps that. Their objective is to preserve and grow capital. The returns are very small if compared to the returns that as retail traders we can generate. They are in the 10 to 20% range a year. Not a lot, but consistent. And that kind of return over a large amount of money year over year really builds wealth. Okay, now let's look at the retail traders. There's a discretionary approach. Very often do not test extensively the method they use, and often they change method. In fact, when people lose money or have a streak of losses, the first thing they think is my method is not working, while in reality is that their psychology is not working. And getting a method that works is not the complex part. In fact, it's one of the easiest part of trading. They have between 1 to 5 positions, unhedged very often. Volatility can be very, very high, but for one position as well as the account. And often they do not understand risk and position sizing, which are two key things. And beware here, risk management is to protect your capital. Position sizing, or also called money management, is to reach trading objectives. And I would ask you if you can write down how many of you have written trading objectives for this year, 2018. Please write it down. If you have it, write yes. If you don't have it, write no. And it's okay if you write no. Okay, please write it down. So retail traders also, they want to make lots of money in a small amount of time, and this is a gambler bias. they are inconsistent, and 90 to 95% of them lose consistently. This is statistics. I'm not making this up, and I'm going to show you that later on, but probably you already know, if you know my work, you already know these figures as well. So objective is to make a lot of money, but because they do not understand trading as a business, they destroy their capital, and that happens much more often than you believe, even if you are mildly successful. Okay, exit the market at the very wrong moment, at the very wrong price, and in the wrong areas, typically before reversal. And doing so, what they do, they provide volume to algorithms and professional traders. That's the sad reality of retail trading. So this is what you need to know. There are many things to know when it comes to trading, and as Alexander Elder wrote in one of his books, any clown can buy or sell a financial security. The fact that we have now modern technology, mobile access, very high-speed access to the market does not mean that we'll be successful. That's just access. That's just a tool that allows us to actually access the market. On the other hand, trading is a business, and you have to not to take no needed risks. Nobody who has a business, who's serious with his business, takes risks that are unneeded. But when I talk to people, even people who had 1, 2, 3 years of exposure to the market, they don't know the most basic things. So they're not being serious about trading. If you're serious about trading, you have to know your stuff. You have to know everything there is to know. I will risk 5% per trade because my capital is risk capital. If I have to keep it sitting on the account, I would rather buy a car with it. So this is a statement of a trader I know personally, and I do not totally agree with this statement, because if something like the Franco-Geddon happens, and we're going to talk about that later on, 5% times 20% move in a market wipes you out. Okay, so while I understand the basis of this statement and where it's coming from, I do not totally agree, and this kind of risk should only be taken on a layer of your money. You should be using a market's money layer when you do this. Okay, so most ignore the basics of trading. They only look at the mechanics of trading, the method, the entry, the plan, give me the opportunity, but that's not the right approach. Okay, the key is to produce steady monthly gains. Then you can use money management techniques to keep growing the account. But of course you need these things here. You need a positive expectancy method, and write down yes if you believe you have a positive expectancy method. If you don't write anything, I assume they're all no. Okay, so whenever I ask, please write it down. I want to also understand where you are coming from. You also need a money management methodology that meets your trading objectives. So question number 3 here is, do you have trading objectives for formally defined for 2018? If you don't answer, I will assume a no. Okay, so please do answer if you have or do not have objectives. And number 2, you have to develop the discipline to execute and monitor your trading consistently and improve continually, because one thing is to have a good method, another thing is to actually being able to execute that consistently. All right, so this is how most retail traders lose money in trading, and I'm sure you might know some of these figures, but in Western countries, new Forex traders lose between 2,000 to 6,000 in the first 3 to 6 months, and then they continue losing. This is aggregate data from Oanda, Canada in 2014, when I was leading the Toronto Forex meetup for FX Street. So in one of the meetings, they actually provided this data here. So if you have to lose 2,000 to 6,000, it's much better that you actually invest that money in a good mentoring coaching program that gives you the basis. At least you had you have not only the basis but also gives you an understanding of how the market works, a methodology with a positive expectancy, and helps you trading really like a business. Over 20% of traders get margin calls regularly. They are overexposed or not understand risk management. This is again coming from Oanda, Canada. Okay, when they looked at the aggregated data they've got from their clients, they saw that 20% of traders get, and they still get, margin calls. Okay, over different European jurisdictions, between 74% to 89% of retail traders lose money on CFDs, and that's one of the reasons, as we're going to see later on, the CFDs are being strictly regulated, and the average losses range from $1,900 to $34,000. Okay, so that's much higher than what people lose in Forex trading. We're talking about Europe here. We're not going to talking about UK. Okay, and then there is the 90-90-90 rule. Have you ever heard the 90-90-90 rule? Have you heard about it? The 90-90-90. Any ideas? Yes, no, maybe? Have you ever heard about that? So far I had 4 questions. All 4 questions, they are no's. Okay, so it means that many of you do not know what I'm talking about here, which is good. So 90% of the traders will lose 90% of the capital in the first 90 days of trading, the first 3 months. Okay, so print this down and put it in front of you. You might be in the 5% of consistent winners, and more power to you, and I'm very happy about that. But if you're not, you have to keep these figures in mind at all times. Okay, now what are the expectations of participants? Before getting into the details of how the industry works, let's look at the expectations of the 2 groups of participants. Who are these 2 groups? Well, the professionals and the retail traders. Okay, now the professionals, they have realistic expectations. They know what they can get out of the market, and they know they're going to get between 10 to 20, 15% to 20% a year. They have trading objectives or targets, very well defined, formally defined. They get rich slowly. It's a business for them. They don't want to make a killing in 1 year. And the expectations and targets are met regularly, which means every year. Every year they make their money, every year, again and again and again. And trading is their job until they retire. It's not a passion, it's not a pastime, it's not something that they're trying to see whether it's going to work for them or not. You can be in that phase at the beginning when you approach trading, but as soon as you decide to put money at work, you cannot just say, let me try how this is going to work. No, there has to be a decision that you want to make trading your business. It's a business. So retail traders, on the other hand, they have unrealistic expectations. Many people who open accounts on brokers that give leverage 1 to 1,000, they actually fund it with $50, with $100, and they believe they can bring that to 1 million in 1 year. That's the unrealistic expectations of many traders. They don't have trading objectives formally defined. They get poorer quickly, and of course $100 is nothing, but as we saw before, the majority of starting traders lose between 2,000 and 6,000 a year, in the first 3 to 6 months. And the expectation targets are rarely met. In fact, 85 to 95% of traders lose money. Some traders, the best students I have, they actually approach trading before reaching out on me. They actually do a lot of testing. They don't lose money. They're the smartest. They do paper trading, and they understand that at some point the trading is not easy, so they need help. But many just, they start trading with real money, which really you should avoid. And if you don't have a system with a positive expectancy, or you don't know what you're trading, you should stop trading real money now and switch to paper trading. Okay, for them, trading is like gambling. It's not a business, and they will eventually lose their money or make known or lose a little bit of it and stop, so their account will be negative. Okay, so really retail traders should not be happy, but should be like this, should be very unhappy, and in fact they are. So how can brokers make business if traders lose consistently then? Okay, so how the brokerage business can continue to exist if traders lose? Have you ever asked yourself these questions? So let's look at the real truth here. Let's look at really what's going on. Luckily, not everybody loses. Also, among retail traders, there is a 5 to 10% of people who makes money consistently. But is that enough to keep the brokerage business above water? So the vast majority of new traders and returning traders will lose all the money in 3 to 6 months. And it was my experience when I started, and I'm sure if you ever traded the real money, that happened to you as well. Very few people make money right away, and when they do, that's the worst thing that can happen to them, because their confidence goes higher and they increase risk and they lose even more than what they would have lost if they had no win at the beginning. And I'm sure that happened to you as well. So brokers must spend an important part of their revenue in marketing to keep a stream of new clients coming in to replace those that blow up. That's the reality. I'm not saying that that's wrong, but that's what they have to do. The proof: check to see the average cost of brokerage paid ads on Google Ads. $20 to $35 per click. That's the reality. Sorry guys, I have to say that, and anybody can check that. It's not that, it's a reality. And I'm just saying something that it's very well known. I'm not trying to this is just reality. Okay, so am I saying that the brokerages are bad? Not at all. In fact, I thank goodness that they actually exist. Brokers are a necessary evil because they give us access to the markets. I do not believe brokers are inherently bad. They offer us an important service, and I am glad they exist. And many brokerages take the risk to start and run a brokerage business. So I'm thankful for that. Also, brokers need to make a living, so they give us a service. They have to make money. If they cannot be profitable, we cannot get access to the markets and make a living as well. So it's very important that they are profitable as well. However, it is our responsibility as retail traders to understand the industry inside out and understand what we need to do to thrive, rather than simply doing what the brokerage, the industry wants us to do. And they want us to do certain things. Are going to look at those because on those things they thrive. But we want to thrive. We don't want to make other people thrive. I mean, when they think about the business, they think of their gains first, not your gains. So there is an inherent conflict of interest, and let's look into that. So is there really a conflict of interest? Yes, of course there is. Do you know the meaning of the expression caveat emptor? Question number 5. Do you know the meaning of caveat emptor? What that means? It's a Latin expression. It's very well known in the Anglo-Saxon world. Not only in UK, but in everywhere, US. So my guess is no. So caveat emptor, it's basically means it's a principle that a buyer alone is responsible for checking the quality and suitability of goods before a purchase is made. Okay, that's what caveat emptor. Caveat means in Latin means beware. Okay, so you have to be responsible as a trader. You can't just jump into trading and believing that it's easy. It's not. It's simple but not easy. It means you must get responsibility and understand what's going on in the industry. And because the industry, the government, the education system will not help you. The field is not leveled. Information is asymmetric. There is a huge conflict of interest, as I'm going to show you here. Many traders who come to study with me start trading without understanding the basic of trading, the mechanics. They don't even understand margin sometimes, right? And and as soon as I explain what I'm going to explain to you, they feel, I mean, how could they do this without knowing these things, right? So be very, if you want to get involved, you're already involved in trading, make sure you know your stuff, okay? Otherwise, stop trading now, move to back to paper trading, and make sure you know what you need to know in order to be successful. And let me give you some information. So again, stop and think. Many people should stop trading today and assess what they know or don't know about trading, okay? And I didn't do that in the past, and that's why I mentor people today to make sure that they avoid the mistakes I have done. As retail traders, we have some advantages. For example, we can enter and exit quickly the market. We are not bound to 10 to 20% a year. Sometimes we can do that in a month. But if we don't treat this as a business like professionals do, we will only act as liquidity providers. What do you think we as retail traders are? Right? Liquidity providers that must be paid for the work they do. And if we do not trade like professionals, we are not going to be paid for these roles. In fact, you're going to do exactly the opposite. We are going to blow our account. So what do you think is our role in the industry as retail traders? Question number 6. What do you think is our role in the industry, in the financial industry? Any guess? Well, I'll say it here, right? Liquidity providers. So yes, we are liquidity providers. We want to be paid for this job in all type of markets. What does it mean, liquidity providers? We provide liquidity to the market, the other side of the trade, at all the levels of price in the book. Okay, that's what we do as retail traders. So in a way, the industry needs us, okay? Because we add liquidity to the liquidity of the main banks and investment banks that all together make up the Forex market. If you listen to what the industry tells you, and I call it inverted narrative, you will do exactly what favors the industry, but not you as a trader. Okay, so we have to be honest and say these things. Okay, and I accept these things because in the end, the brokerages are bringing a service to me, and I accept the fact that they are paid for their risks. Okay, they are a business, and we have to work as business as well. So what the industry tells us? What do you think the industry tells us? The financial industry, the brokerage industry. Well, what are the messages that you hear again and again from the industry? What you see happening all the time? Any ideas? So question 7 here. What the industry tells us. So what are the messages we hear again and again? Well, they trade a lot, which means generate commissions at least twice a day if you take one trade every day. But many people take much more than that. So trade frequently. That's what the industry tells you. And the industry also tells you trade on the small time frames, for a few pips, and trade big. But did you know that the real money, really several double digits on your capital, is on the larger time frames? That's what the real money is. But because the industry as a narrative that favors the industry, you never thought about that. So they ask you, trade frequently and trade big sizes. Trade the news. Yes, give liquidity to smart money that actually needs to exit their position during the news. Smart money is already well positioned for weeks, sometimes for months, and we can see that on the charts as well. And why do you think there is a big hype about trading news? Do you think it's really important to trade news? What is important to, take money out of the market on those big, huge moves of 300, 400, 500 and more pips? It's certainly not trading the news. And if you like that, fine. You are actually listening to the brokerage's narrative and the industry narrative. So trade when the market are unpredictable. So you will lose money, and by doing that, you're going to give your liquidity to the smart money professionals, algorithms who have to exit the market during news. Because see, professionals, they know what's going on. They forecast, and their forecasts are very, very good, extremely good. Before I say 80% of professional traders, they use fundamental analysis. They know exactly what's the path of least resistance based on fundamentals. They have many more resources they can spend in research that you and me can. Okay, so it is possible to quickly make big money in Forex, yes, but only if you treat it as a business, develop a robust system with positive expectancy, and take a long-term view. But the industry is telling you, yes, it's possible to make quick bucks in Forex. And before, that was also supported by very large, important leverage. And as we're going to see in a minute, that leverage is coming down. Okay, so forget the 1 to 1000s, 1 to 500, 1 to 400, because the trend is changing. So if you trade based on that, and you shouldn't, because it means that you're taking too much risks, then that kind of trading is gone. Okay, and that kind of trading almost 100% of the time leads to losses. So do you start seeing it? The industry wants you to trade often so you can generate lots of commissions, either blowing your account up quickly or giving a sizable part of your gains to the brokerage, which is, that I accept, because after all, we are getting a service from the brokerage. I have nothing against that. Don't not get me wrong, okay? But you need to make sure you understand what benefits you as well, not only the brokerage's business. We need the business, we need the brokerages, because we need access to the markets. Okay, now to do this, in order to understand what benefits you, you need to understand how the industry works. And I'm gonna give this to you that nobody gives nowhere. Okay, this information you can also find online if you know what to look for. So I'm not really revealing any secrets here, but the reality is that even experienced traders do not understand the information that follows. So pay very good attention here to what I'm about to say. And very few will tell you these things, okay? How the industry works, how it all works. When a new brokerage business or investors come up with, investors come up with money, they can come up with 50 millions or 100 millions or more, right? So this is the money that the owner of the brokerages put down. So what they do, they go to a big investment bank and they ask credit for 5 to 10 times that sum. And now they would have access to a revolving facility from the big investment bank of 250 alpha billion. Okay, and let's say that they can get it for a 3% yearly interest. It's not that bad. Okay, now remember, yearly interests are going up. That's the trend, at least apparently. Right, there is a currency war going on, so obviously the country will fight. And for example, you saw recently the Royal Bank of New Zealand saying they're not going to increase rates anytime soon, and that's the reason why the New Zealand dollar is moving lower compared to other currencies. So, but generally the trend seems to be higher. Okay, we saw US increasing rates for the first time, Canada doing the same, and so on. So the brokerages can now lend that money that they take at 3% to retail traders in form of leverage. Where do you think the leverage is coming from? The leverage that you get from your broker. And let's say that they can give the money to you for a 4% or more. And I'm not only talking about the Forex business here, brokerage business, but also the stock brokerage business. Whereas you can get, 30% margin or 25% margin. In Europe, it's now 20% margin, which is 5 to 1. Okay, so where do you think the money is coming from? Well, it's coming from this facility here, a revolving facility. And the swap in Forex, it's an expression of this, and it's one source of income for brokerages. And I understand that. I mean, they're taking the risk and they're giving you money and they're getting a financing turn on you of 1%. I have nothing in contrary or against this. Brokers are paid for taking risk and bringing access to the markets to retail traders. Okay, so please understand that. But some believe that not only the brokerage investment money is given as collateral, but even the retail traders' money in the accounts is given as collateral to the investment banks. Now, I'm not sure if this is right or wrong, because if that is collateral, then if something goes wrong, I'm going to lose that collateral as well. And according to new regulation in Europe, that's not longer possible. Okay, so I'm not sure. I'm not sure about that, whether it happens or not, or is going to happen in the future. I don't have any proof. However, this and whether retail positions are hedged by brokers could explain why some brokers never came out from the 20% adjustment of the Swiss franc in 2015. So, do you know what I'm talking about? What happened in question number 8 here? What happened at the beginning of 2015? Swiss National Bank. What happened there? The peg with the euro was removed. Now note that this is going to change because the negative balance protection, it's one of the elements of the new ESMA regulation, the European regulation, and this is going to become the standard in the business. Okay, negative balance protection means that basically you cannot go into a situation where you have a debt with the broker. You can lose all your money in the brokerages, but you cannot have a debt with them. Okay, and that happened during the Swiss franc crisis. It's not really a crisis, not for the Swiss franc, it was for the brokerages. So what happened at the beginning of 2015? Many of you might know that the Swiss central bank made a decision to remove the peg with the euro, and so it makes sense to look at the consequences. This was early 2015. Now, from now on, I'm going to mention some brokers' names, and I want to make this disclaimer. I'm not associated with any of the Forex brokers mentioned, and what follows is not a recommendation to do business with any one of them. I give this information only for your general knowledge, and the information I'm reporting here is in the best of my knowledge, and truthfully I will not be responsible for any omissions or decisions you may take because of what follows. Okay, so this is very important. And so without doubt, the Swiss National Bank, which I'm going to call SNB here, in January 2015 to stop supporting the Swiss franc and remove the peg with the euro was one of the biggest events in 2015. This event shook the Forex market and left some brokers like Alpari UK filing for bankruptcy, and FXCM scrambled for a bailout to survive. This is not the first time something like this happened. In 2008, PG Best, which was also the brokerages of the World Trading Championship, actually went down. So they were doing something wrong. Okay, I'm not saying that these guys were doing something wrong. Eventually, FXCM lost its US license, and basically the clients were applied by Gain Capital, which is the owner of Forex.com, in February 2017. So during this event, there were some winners, there were some losers as well. The huge volatility and the 20% overnight movement in the Euro Swiss franc and US dollar Swiss franc and all the pairs that are related to Swiss franc following the SNB decisions had different consequences for brokers. So it means that they were doing different things. Some of them weathered the storm without a scratch, while others lost hundreds of millions of dollars. Why is that? Why is that happened? Why? It means that not everybody managed things the same way. So what happened to retail traders' money then? The winners of the so-called Franco-Geddon, this 20% move in the Swiss franc related pairs. Well, the winners were IC Markets, DirectFX, Oanda, XM, Hot Forex, Forex.com were left without a scratch, and this is the opportunity to attract more clients from distressed brokers. Now, again, I'm not recommending any of this, okay, as I mentioned in the disclaimer before. XM was quick to point on its own page, and this is very important because this is relative to our changes in the regulation. The negative balance protection is one of its most important values, and traders are guaranteed never to go below zero. Okay, and some brokerages went well above that, beyond that. DirectFX was the first broker to pay the clients debt caused by the event. What a great event, right? And they were just anticipating the trend that is now being established by ESMA in Europe with the new regulation, because no negative balance anymore. So there'll be a protection for that, and you will never need to pay any debts to your broker. And this is going to become the norm in this business. Okay, which obviously it's a blow to the brokerage business, so they will need to hedge, and I'm going to show you what they do to hedge that. So the SNB shock has meant game over for some of the brokers and a huge drawbacks for other brokers as well. They either lost their license, their clients, or they lost hundreds of millions. Okay, note why there were winners and losers. Now that's something that you have to think about. Why was that? Is that because some have hedged and some not? It's because some were operating as Forex market makers and others as ECN SPT, which is straight through processing, without just putting those orders on their liquidity provider network, and that's it. Or because they hedge traders' positions. Well, we don't know the details, but it's fair to ask, do brokerages hedge retail trades? Right? Some people believe brokerages do indeed hedge, and they do it in an automatic way, and I believe that too. And it's not necessarily something bad if they can protect me. So whenever you open a new account, your trading will your broker will observe. Your trading will be observed by your broker. Okay, so your broker will observe you, and that's okay. After a few months, it will be clear whether you are a consistent winner or consistent losers, and 95% are consistent losers. Sorry, that's the blunt reality. How does the brokerages use this information? And can they do that? Of course they can. It's their business. You are part of their business. They need to know what you're doing. Well, if you're a consistent loser, like the majority, you will be put into a bucket called L for losers, or any other name. I don't care. It can be A or B. If you're a winner, instead, you will make the W bucket where the group of the winners go. Okay? I don't know if you knew these things. Give me a yes if you knew these things, or a no if you didn't know these things. Do you know these things about trading? If you're a winner, instead, you will make the W bucket. Okay, now I cannot be 100% sure about this because no broker has ever confirmed it to me. I work with several brokerages because I have account with several brokerages. I'm not an IB. I'm not an introducing broker. I don't believe in that, and I'm going to show you why. However, some traders and professionals believe this is the standard practice in the industry. But if it is, I have nothing against it. So this is the tale of the two buckets then. Whether brokerages edge or not, I do not care, and it is their own business, and I'm okay with that. They certainly have inside intelligence and information about us, retail traders, as they can see our trades. Of course, they give us the opportunity to put them up. As a retail trader, I am doing business with them, and I believe they are free to study my trading and who they are doing business with. That's be the same thing I would do, if I have a business. It's only a good business practice, and actually I encourage it. So I have no problems with that, and it's their choice if they want to edge my trades or not. Okay, I just want to know it. But if they do indeed edge the trades, I can infer that their behavior must necessarily be different for traders they put in the losers bucket from those traders that they put in the winners bucket. Okay, I cannot believe they do exactly the same things. In fact, I believe they don't. How the losers are treated then? If the trader is a consistent loser, it is possible that this happens. When the trader puts up a new position, it opens a position, then the brokerages will take a trade in the opposing direction. I'm not saying that they're market making, they're doing the market, they actually never putting the client trade on the liquidity provider network. I'm saying that they're taking also an additional trade in the opposite direction. Okay, they just do that. They could edge their own trade as well or not. Now, what happens when the trader closes the position at a loss? Well, because the consistent losing traders loses, then the brokerage that they have opened their own position in the opposing direction, they will be making money. They'll be making again. Okay. So how much money did the brokerage do on this trade? Any ideas? Well, let me give it to you. These are the source of income of traders, of brokers. The spread plus the commissions, and we know that very well. We know the swap as well, or loan, if you buy and sell stocks on margin. That's the financing term. That's that 1% difference that they make on your position. And number 3 is the gain on the other side of the position. These are all the revenue streams when they trade. They have a losing trader. Okay, a losing trader will generate for the brokerage all the revenue streams. Okay, I don't know if you knew these things, but these are very important. So, as I mentioned before, I believe that winners are treated differently. And let me show you why I believe that. Because if the trader is a consistent winner and is in the W bucket, it is very possible that when the trader takes a new position and opens a position, then the brokerage not only will take a trade in the opposing direction, okay, but now they also have to buy the underlying, or they have to buy a derivative to edge their own position. Okay, so mind here, now there are 3 positions at work here. There is the position from the winning trader. There is the opposite position from the brokerage, right? They will need to do this because this trade can be successful or can also be unsuccessful. So they have to do this, right? If he's successful, they will lose money. If he's unsuccessful, they will make money. However, because there is a case in which this trade can be successful and they can lose money, they need to take another trade, number 3, and hedge number 2. Okay? Is that complicated? It shouldn't be. It's very simple. There are 3 positions involved here. They need to hedge 2 in case the trader makes money this time. They know that it's a consistent trader, so very often he makes money. If he does, they're going to lose money. So they need to hedge that position. Okay, it's not complicated. It's just common sense here. So when the trader closes the position at a gain, what's going to happen? Well, the brokerage will close their position at a loss, but thanks to the edge, they're not going to lose any money. Can you see it? The brokerages always falls on their 2 feet. They always falls like cats. They never, they never get in trouble. They move around in a way that they don't lose money. So the brokerage has not lost money. So how much money has the brokerage has done now on this trade? Well, they only made the spread plus commission plus the financing turn, which is the swap or the loan, but not all the revenue streams. Why? Because they don't make money on taking the opposing trade, okay? And they have to hedge it. Can you see it? Can you see how it all works? Can you see what's happening when you trade? Okay, so do brokerages want retail to make money? Well, of course they do, I believe, but they're not incentivized, and that's the problem. So what do you think we can deduct from these examples? Well, that indeed if brokers take the other side and edge, and some people believe this is all automated since many years now, and I believe that too, then brokerages, and I'm talking about not only Forex brokers here, but stocks, futures, the central exchanges have no incentive in having winning traders around. We are annoying as winning traders. There might be 2 important reasons why brokerages may not like winning traders. Okay? Yes, we might be annoying to them. Number 1 is that with winning traders, they cannot realize all the revenue streams. They can only realize the spread plus commission plus financing turn. Okay? And that's the first reason, and I showed that to you. But there's a second important reason. They need to put up more money to take the other side of the trade plus the edging. You remember I mentioned trade number 2, which is the other side of the trade. Trade number 3 is the edge. Where do they get the money to do that? Well, they get the money from the investment bank, so they have to pay interest. Adam is saying, excellent webinar. Thank you very much, Adam. Nobody's telling you these things, okay? So they have to pay interest on the use of their money, okay? So I'm not saying that the brokers want you to lose money, but really it seems that if things work like this, then they're not incentivized to do that, okay? And nobody's telling you these things, and I wonder why. Okay, so I do, because I care about people to avoid the mistakes I've done in the past. And if we get involved in a business, we need to know how the business works. So how the industry really works. This is how the industry is organized. And this is a very high level organization. And it holds for Forex, for stock brokers, for futures brokers, and anything that we as retail traders can trade. Of course, we're going to focus on Forex. Okay, so there are a number of large banks. They're all connected together. Some say the most influent banks are 7 or 9, and then there are investment banks as well, which are connected to these banks as well. Okay, we know that the Forex market is not a centralized market, but it's a group of liquidity providers that are connected together. However, for Forex and stocks, for stocks and futures, we also have the exchanges, and of course, the investment banks and the large banks are connected to the exchanges as well. But for now, the exchanges, we will keep them out of the picture here. Then there are retail brokers and introducing brokers and the retail trader, which is the dump money that loses money. Okay, so how it all works then? The retail brokers put up the money and gives the collateral to the investment bank. The investment bank gives a credit facility and gives clearing facility and access to the markets. Okay, access to the liquidity providers, to the actual market. Retail brokers sign an IB introducing broker agreement with introducing brokers, and introducing brokers, what they do, they bring clients, right? So in a way, the introducing brokers act as the marketing body of retail brokers. Okay. and they get rebates from the brokers. The introducing broker, what do? They actually they provide education, and I'll have a talk about education of introducing broker. I'm not an introducing broker, I will never be. I made a conscious decision when I understood how all this works, okay? They give education, in inverted commas, and of course the retail traders gives fees, financing costs, and unfortunately loses money to the market here. So in this picture here, what is the smart money? What do you believe is the smart money? Question number 10. What is the smart money? What do you think is smart money? Well, the smart money is these guys here. They never lose. And actually they have nothing to do with retail traders if you look at it, right? They're never directly involved with retail traders. We cannot say that the smart money is responsible for, any of the wrongdoings or things or conflict of interest. They're not. And who's the dump money? Well, the retail trader, if we don't learn what to do in the right way, okay? And what we have here in the middle, it's a huge conflict of interest. Yes, sorry to say that, but it doesn't mean that, the brokerages are bad but there is a conflict of interest because the incentives are not aligned, and that's it. That's a reality. I mean, it's not something, it's not a secret. The incentives for retail brokers and introducing brokers are different from the incentives that we have as traders, and I believe everybody has to make a living in this business, so otherwise it's one-sided. And in that case, retail traders should stop trading and giving their liquidity to these guys here, okay? So I think it has to be a fair game as we talk about regulations. So you start seeing it, retail brokers are incentivized to create a narrative that increases your chances of losing money. And I'm not saying that they want you to lose money or they make everything they can to make you lose money, but they're not incentivized so that you make money. This is not because they hate you or they want you to see you successful as a person. In fact, if you do the right thing, you can be wildly successful in trading. It's just business. They make money when you lose money, and winners are annoying. Caveat emptor. It's on you. It's your responsibility to learn the game and learn how the industry works. Not impersonal, but you losing money is just good business. All right? So they are heavily incentivized to make you believe in short-term trading and to push you to trade as often and as big as possible. Okay? It's just an incentive because of how we how we saw the industry works, how they treat differently winners and losers. Again, this is how the brokerages makes the brokerages makes their money. Spread plus commission. This happens with both losers and winners, and I'm okay with that. If I'm a winner, I'm okay with that. I mean, I need to pay access to the markets, and I'm totally okay with that. Finance in turn, a swap or margin. Again, with both losers and winners. But winners are annoying because, the other side of the trade, with no edging, they can only make money with losers. So they have an incentive. They might have an incentive with that. I'm not saying they do. They might have an incentive for that. Okay, so to have your losers so that they have also this additional revenue stream. And we saw that winners are annoying because they have to use double their money. They have to take the other side of the trade. And they also have to edge the other side of the trade, because even if you're a winning trader, they don't know whether the next trade is going to be a winner or a loser. Can you see that? So a word about educators now. Educators who are strongly linked to brokers will foster the narrative of the brokerages. As easy as that. Okay? And the only narrative that is convenient to the brokers is an inverted narrative that pushes you to do what is convenient to brokerages, but that might not necessarily benefit you. All right? And indeed, 95% of traders lose money. So you should really think whether the educator is helping you if you're losing money. And you might be, making money, losing money, making money, losing money, being profitable but not consistent, which keeps you at a level where you can really never break away. And that's a level that is convenient to but the brokers and introducing brokers, because it keeps you trading a lot. So anybody who wants you to trade on the 5 minutes, on the 1 minute, on the smaller time frames, you should really look around and consider other ways of trading, because that is going to bring you anywhere. And at some point you'll just, even if you have not lost money, if you stayed profitable, you're just breaking even, and you're losing your time. You're spending your time doing an activity that does not generate any money. So cold educators who cannot make any money in the markets will need rebates. There is also this. If you can make money in the markets, right, why would you be an introducing broker? And to full disclosure, in the past I've considered that, but then I understood, why should I do this? Why should I keep people trading frequently if that's not what I do? I don't trade frequently. I may take, sometimes 6, 7, 8, 10 trades in a month, but they're all on the larger time frames. And that's where the money is. And obviously, brokers do not like me, right? And so educators who need rebates, who are introducing brokers, beware of them, because that will push you to make a lot of these rebates. That will push you to trade like dump money and not like smart money. I like to trade like smart money. In fact, I teach people to trade like smart money, like algorithms, and how the places where smart money sources volume from dump money as well. So you must learn to trade with educators who do not have an IB agreement. In my opinion, I respect everybody, but in my opinion, there is a conflict of interest that might not be the best for the trader if the educator is also an IB. And trader understand how professionals trade. Okay? The best educators are those who are not involved with IB agreements, in my opinion, my personal opinion. Okay? Changes in Forex regulation, and only because they don't have any conflict of interest. Now, I'm not saying that people that might have conflict of interest are inherently bad, or they might be, working in the interest of the trader as well. But are they incentivized to do that? That's the question. Recent changes in the world of Forex include more strict adherence to regular bodies, for example, enforcement of bans of non-regulated brokers in US and Canada, general reduction of leverage by regulatory bodies, the new ESMA, the European Securities and Market Authority regulation on binary options, CDFs, and restriction and leverage. We're going to look at that. Things are moving quickly in the Forex and derivative markets, CFDs, contract for difference, due to two main reasons: scams and generalized losses in Forex, binary options, and contract for difference markets, and the inverting trend with the interest rates around the world. There is a currency war, but there's also a tendency to unwind all the QE and start raising and continue raising interest rates. Okay, so this is going to affect the Forex business somehow. How? Canada and US offer recent stories in relation to enforcement of regulatory bodies. I had to close my Pepperstone account in Australia. I live in Canada, and the regulatory body and Pepperstone itself said, we can no longer offer this service because we are not regulated with IROC. Some brokerages that were allowed to operate before without being regulated by the country regulatory body, and that's the IROC in Canada, and the SEC and the CFTC in US, will not be able to operate in few weeks. I still have one of my accounts with Pepperstone, but it's going to be closed, unfortunately. Examples are Pepperstone in Canada and US due to lack of certification with respective regulatory bodies. Okay, TradeStation, which is very successful, and it's still my charting and future platform. Already banned for Canadians in Ontario from stocks and Forex and option trading, but it is still regulated to allow future trading. So I still use that for charting and futures. Alberta province, I'm still talking about Canada here, requires traders to in leveraged instruments to even become accredited investors, which obviously it's not easy, but there are ways around that. Okay, so what it means for Forex and other traders: there are still many options in Canada and US, as well as other provinces, as well as in Europe, of course, to trade with local Forex broker or brokers in UK that are regulated by their respective regulatory body. In Canada and US are the IROC and the CEC and the CFDF. Okay, the options options are here actually this is incorrect. Options are, these are two different things here, so forgive me. Options, because of the fact that CFDs, contract for difference, are not available in US anymore, they're banned in US, as you know very well. Options are being used as a substitute for CFDs. Okay, but here what I intended is also options to that are available because of these restrictions are Forex.com, Questrade, FXTM, which also has an international license, FX Glory, FXDD, Think Markets, Vantage FX. Now, please remind the disclaimer I've mentioned before, because I'm not recommending or necessarily endorsing any of them. I can say I use Forex.com and Questrade for some of my accounts. CFDs, contract for difference, are banned in US, and options might be the only alternative, but many think that they're not good for directional trading as CFDs. I have no experience with those, so I cannot confirm that, but just do your own research. CFDs are available in Canada, for example, with CMC markets. In general, there will still be opportunity to trade Forex in US and Canada. Okay, so the opportunity is still there. Please do your own due diligence and verification of the information above. I do not endorse any of the brokerages mentioned and the brokerages that I'm going to mention now. Leverage is going down. This is another trend. Okay, everywhere in the world we are seeing the trend. There are still some island of happiness that will soon go away. 1 to 400, Australia, New Zealand, 1 to 500, even 1 to 1000 in Belize with FX time. But that might change soon. US, Canada brokerages are regulated to offer up to 1 to 50 or 50 to 1 for some pairs. For example, Forex.com offers euro dollar with 2 margin minimum. Okay, so if you want to trade one lot, you have to put 2,000 down. Europe will soon reduce the leverage on Forex to 30 to 1 or 1 to 30, down to 1 to 20 for some non-major pairs. Okay, and we will also see 1 to 5 for stocks, which is not too bad. 20% margin, it's not too bad, but it's a blow for Bitcoin. 1 to 2. I'm not a fan of Bitcoin. I don't think we need Bitcoin as traders, because people who start trading Bitcoin, they clearly are not professional. They're only following a fashion. They don't understand the markets. For example, the only fact that Bitcoin does not have a lot of past historical data is for me a no-no, to not take that into consideration. But for many people, the majority, Bitcoin is just a fashion, and they're going to lose a lot of money on that. So what it means for Forex and other traders: Forex funding your account, forget funding your account with $50 and trying to bring it to 1 million in 1 year. That's never going to happen. That never happened. If it happened, it was for pure luck, and it's gambling. It's just winning the lottery. If you came into Forex to win the lottery, then just play the lottery. Why come into Forex, right? I mean, Forex can be made a positive expectancy game, and you can make money with it, but you have to treat that as a business, which means that you have to start adding zeros to this 50. 2 zeros, better 3 zeros. Okay, and so you have to see this as a long term. You have to have a plan to add to your account, learn the game, invest in your knowledge, and make it a successful business. Only serious people will want to develop trading as a business, in fact, and invest in education and eventually build a good starting account For example, 10,000 or even 20,000 just as a start, and then grow it gradually will make it. So you will likely need to move to larger time frames in order to do that, where the real money is, by the way. If nobody told you, I'm telling you. Learn position trading rather than being excited in entering and exiting the market at all time. Position trading is all good. You trade 4, 5, 10 times a month and you make double digits. That's it. It's a business. 30-1 or 1-to-30 is still a good leverage. That means 300,000 worth of product or 3 standard lots for a starting account at 10,000. Okay, but forget the 1,000, the $500, the $50. That's not how Forex works. In general, how trading works. It's a business. On the other side, remember, on the other side, there are professionals that are there to take your money if you know what you're doing. Okay, so you have to think of this as a business, not something that you can do in your spare time or you're trying how it goes. Okay, so how the ESMA regulation is going to change this? In Europe, some bad practices will disappear, but problem might not be solved completely, and that's the conclusion. Binary options will be banned in Europe. This decision is likely to be followed elsewhere in the world. This is just good business. So forget, binary options. They're not good business. You can lose 100% and win only to 80%. So the reward to risk is not skewed on your side. Restriction on the marketing, distribution, or sale of CFDs to retail investors. Leverage on Forex will also go down, as we saw already. 30-1 for majors, 20-1 for some of non-major pairs, 10-1 for commodities other than gold and non-major equities, 5-1 for individual equities and other reference values, and 2-1 for cryptocurrencies. Finally, a margin close out rule on a per account basis. Notice that per position basis was also considered, but then was eliminated from the regulation. And of course, negative balance protection that we spoke about before on a per account basis. So you will never end up owing money to a broker. Okay, what it means for Forex and other traders? Well, binary options are a scam. I believe it's a scam and do not reflect a healthy payout ratio. In fact, the maximum is 0.8, which is much less than what it should be, at least 3. They're just not good business, and the ban is very good news to me. I hope it is for you as well. Generally, a reduction of leverage is a good thing. Considering also the rules on margin on account basis, that will require a better understanding of price structure, what smart money and dump money are doing, and that's what I teach as well, and setting stops properly. Higher account amount and experience will be required to trade CFDs, so there'll be some restriction on the marketing in Europe. But let's look really whether this is good or not. More good news is that you can no longer lose more than your deposit, and we saw that that's the negative balance protection. The idea that you could end up owning a broken money has always seemed slightly unjust, right? I mean, I think it makes only common sense. If broker's margin requirement was too low for the market, it does not seem fair they could pass their loss on to you, is it? It's not fair, right? They can do that. In fact, if the broker is a market maker that does not hedge to make more profits, then losing money is their own risk. The negative balance protection will become routine, I believe, everywhere in the world. Okay, and we are seeing also many brokers who have anticipated that trend in 2015. DirectFX was the first paying the debt of clients. So what it means for Forex and other traders. Reducing leverage now will not necessarily reduce the amount of losses, but just the speed at which they appear. Okay, and why is that? So to me, this regulation does not grasp the very nature of traders, especially starting traders, because traders who do not actively and consciously make the decision to get a proper trading education and work with a mentor will lose anyway all the money before they learn. Okay, that's a very important point. Actually, even the opposite is possible. Because the leverage is now 30 to 1 instead of 400 to 1, people will need to put 10 plus times more money to get the same results. And believe me, gamblers will do that, and all starting traders are gamblers because they really do not understand the business they're getting into. That's why when I, in one of my coaching programs, the Fearless Traders program, the first thing I teach is actually how the brokerages works, and I teach about risk management and advanced risk management. Okay, and starting traders who are really gamblers, and that's why become losers, will do that. They will put more money. So so limiting leverage may well push traders to make even bigger deposits, which means that they're going to lose even more money. Okay. And it's possible that ESMA has missed this important point, and that's my critique to it. Being a regulatory body or authority with little or no experience in trading, it is important they have not grasped, it is possible they have not grasped the fundamental truth that affects starting traders. They are all compulsive gamblers. I was when I started, and then I started understanding that this was a business. Even if they lose the money more slowly, if they have to deposit 10 to 20 times as much money than when they inevitably blow up the entire trading account, then they will just have lost more money, all right, than they otherwise would have done. So I'm saying this as a critic of the ESMA regulation, my own personal viewpoint here. I'm not representing the views of FX Street or any brokerages or my own company. That's my own personal view. But the point is that this is a risk, right? This could happen. So it's even for you further, motivation to become a smarter trader. And before I give you the important conclusions, I want to invite you, if you're a starting trader or not a consistent trader yet, I want to become successful, to consider my mentoring that has been helping hundreds of traders to become successful in trading, and many of them are producing 2 digits per month. On Forex, and not only. I am a full-time trader myself, trading Forex, stocks, CDFs, and futures, and have 2 coaching programs going on at the moment. They're called the Fearless Trader Workshop, which is a 12-week live intensive workshop. If you're really a serious trader from any level of development, wants to quickly bring their trading to a very advanced level and become profitable and consistent in a few months. And then I have my traditional FIPS Talker methods, which is now in express version, which is a complete program made of 3 phases: self-study, live webinars of 12 weeks, and also a trading analysis room and consolidation. And this is a coaching with individual attention. It's a group coaching with individual attention, which will help you master the effective application of one of the edge I use, the smart money, and I call that the FIPS Talker methods. So if you don't know my work, you can go on my website, fipstalkertraining.com, as well as on FX Street, and learn more about my edge. This program is not for beginners. You need to have at least a few months of experience and a basic understanding of the market. So I invite you to review this on my websites, and if you have any request, you can go on fipstalkertraining.com or drop me an email, and don't forget to get the free course here. Now let's look at the conclusions, and I'll let you go. This has been a very long, but to me very interesting webinar. What do we need to expect going forward? Retail trading is here to stay, because as I showed you, the smart money will not renounce easily to the liquidity that is provided by us retail traders. Okay, I showed you how the industry works. There's no reason to believe that someone wants to, as I hear sometimes, someone wants to, remove trading from retail traders. They will never do that. Why? Retail trading is part of the plumbing, the architecture of the markets. It all happens automatically and will continue to benefit the smart participants, which are the smart money, the brokerages, the successful and profitable traders. Unfortunately, only 5%. If you want to be in that elite 5%, come to work with me. The news regulations are positive. Overall, and 20-1 and 30-1 will still allow those who take trading seriously to trade effectively. An environment of growing, higher interest rates and reduced participation from traders who will not be able to fund small accounts may make the industry more competitive. Okay, and more competitive, I hope not more aggressive. Okay, because if they're making less money from small accounts, yes, the small accounts might not count a lot, but still it's less money, right? So I don't want this to be a reason for higher competition and more aggressiveness that could result in some brokerages becoming too aggressive, okay, and then lose our money. This is the session here that is starting, and sorry about that. And that's the US stock markets opening now. So regulation will become more stringent, and this should discourage bad practice on the other side in brokerages. Okay, and for example, like market making, no hedging, and so on. Okay, so this is it for today. I hope this was interesting and useful. Please send me your feedbacks at vipsoccer@gmail.com. I hope this was you learned something today. For sure you learned how the brokerage works. And again, if you have any questions, you can write to me, and you can also review the Fearless Trader workshop and the VIPS Cameras coaching program, which we're going to be offering on FX Street at a special price as well in the coming weeks and months. All right. So thank you very much, and you have a great one. Bye bye now.